Let's turn now to another big story that we are watching here, and that is big tech and the Magnificent Seven. You're taking a look at just 4 of those 7 stocks right now on your screen. You've got Nvidia, Alphabet, Amazon, and Microsoft here. You can see that Nvidia is moving up to the upside, Alphabet to the downside, and Amazon to the upside here. But this comes after we saw the broader market flipping this morning to the downside after a volatile week for markets, particularly in the big tech trade. Mag 7 lost a lot of value last Monday, but regained some of the losses toward the end of the week. Investors wondering whether we'll continue to see that rotation out of big tech and into small caps that got a bit derailed by the broader market sell-off. So what's next for big tech? Joining us now, we've got Rich Bernstein, the CEO of Richard Bernstein Advisors, joining us remotely. Rich, great to have you on here. So listen, we were just talking about the data prints to come for this week, and I'm curious from your perspective, what is the biggest print that you're going to be watching, and how are you positioning around that?
So, good morning, guys. I think clearly the big one this week is the CPI. We are not event-driven managers, so we are not going to change our positioning regardless of what comes out in that report. We're very fundamentally driven. And I think the biggest story for true fundamental investors, it's not so much inflation, it's not actually the Fed, it's actually earnings, and earnings in the second half of the year. And the reason I bring that up is simply because by the end of this year, analysts in the street are forecasting that small caps, emerging markets, and the world X the Mag 7, as you just referred to them, X the Mag 7, all those groups are going to have stronger earnings growth by the end of this year than the Magnificent Seven themselves. We think that is the big story that's going unnoticed right now.
But Rich, if you take a step back and even just coming off the volatility last week, is it too early given the slew of factors that we could see really drive volatility here, at least in the short term? Is it too early to say that we are in the clear? And do investors very much still need to be on watch?
Oh, well, I think, look, I mean, bond volatility is up, and bond volatility we haven't seen at these levels in quite some time. That's going to translate to stock volatility. There should be no doubt about that. At the same time, the lagged effects of the Fed raising rates and withdrawing liquidity from the financial markets, that's going to have an effect on volatility too. Volatility tends to go up after the Fed tightens, not while the Fed tightens, but actually after the Fed tightens. So we should expect more volatility rather than less. I think that should be the norm going forward here.
I want to go back to what you said about the broadening that you are anticipating and the growth, the earnings growth that we're going to have outside of the Magnificent Seven and small and mid caps, EM, global equities. I wonder, is that a concern? Because so much of the market gains that we did see in the first half of this year were driven by those gains in the Magnificent Seven. Can we still see a happy year end for those S&P price targets if we get the rotation?
Right. Well, we don't make S&P price targets for a reason, and one of the reasons is exactly the issue that you're coming up with. Look, we've described the stock market as a seesaw, with the S&P being the fulcrum of that seesaw. On one side of the seesaw, we clearly have the Magnificent Seven, and on the other side of the seesaw, we have everything else in the global equity markets. Obviously, our portfolios are positioned on that other side of the seesaw. That's where we think the opportunity is. In fact, we described it as a once-in-a-generation opportunity. But you're right. If the Mag 7 comes under pressure and they dominate the indices, and if volatility goes up, it's hard to make the argument that the market, the way people like to talk about it, is going to do well. I think the bigger story is going to be which side of the seesaw you're on, not necessarily the market, the way you described it.
Rich, how does the Fed cut factor into your thesis at all? Does it matter about the timing? Does it matter to the degree that we're going to get the cuts?
Yeah, so that's a key question right now, actually, because normally when profits are accelerating, the Fed is tightening. We may actually get the combination of profits accelerating and the Fed cutting rates, which is very unusual. And so what could happen is that the Fed, by cutting rates, I would argue somewhat prematurely, but by cutting rates, that they fuel this rotation in the seesaw, and that the other side of the seesaw, small caps, emerging markets, all these other things, actually do better than people think because of that added liquidity from the Fed.
Is that side defensive right now, Rich, or is it just where you see the gains heading?
So oddly enough, you could make the argument that things like small caps could be defensive. I mean, that sounds ridiculous, right? Off the top, how could small companies be defensive? But if you look back after the tech bubble, when we also had this tremendous imbalance, sort of the seesaw effect, in the years that happened, and even as the Fed tightened subsequent to that, very cyclical sectors and small caps did prove to be defensive. And the reason why was the seesaw effect, and the rebalancing of the seesaw became more important than maybe the economic fundamentals.
Rich, before we let you go, I also want to talk with you quickly about some of the notes that you sent over about the opportunity that you're seeing outside the Mag 7. But even beyond the small cap space, you also made the case that industrials, it's the best long-term investment sector too, and that it's much better than AI themes. Talk to me a little bit more about that and why.
So it's at Richard Bernstein Advisors, RBA, at our firm, we always live by the rule that you want to be the one banker in a town with 1,000 borrowers. Think about that one banker in a town with 1,000 borrowers. He or she is going to mint it because they're going to set the interest rate on every loan. Turn it around, right? 1,000 banks, one borrower. The borrower makes out like a bandit and gets an extraordinarily cheap cost of capital. It's hard to argue if you're investing in AI right now that you're the one banker in a town with 1,000 borrowers, right? Long-term returns are purely a function of the supply and demand of capital. And with AI right now, you've got an oversupply of capital, right? Where do you not have that? It's actually in deglobalization and the reindustrialization of America. I mean, everybody understands, here's a way to think about it in one sentence. Everybody understands the national security implications of the United States being dependent on the rest of the world for semiconductors, but why do we not understand the risk of being dependent on the rest of the world for everything? And so as deglobalization takes effect, the United States economy is going to have to reassert its independence, which we think the industrial sector is the key component of that independence.
Rich Bernstein, we really appreciate you taking the time to join us here this morning. We hope to also have you back soon. CEO of Richard Bernstein Advisors. Thanks so much.
Great, thank you.